Our next guest says the biggest fear for investors currently is the fear of missing out on the market's momentum higher. For more on what options are saying about equities, we have Amy Wu Silverman here, head of derivatives strategy at RBC Capital Markets. Good to have you, as always. So what are you looking at? Which sections of the option market indicate to you that there's, I guess you'd call it FOMO, if we were texting each other?
Lots of FOMO, and I don't think the stocks would surprise you. NVIDIA, a lot of the semi-space, mega cap tech. And what I think is very telling of this is since post-COVID, that fear of downside, this idea of hedging in the market has all but disappeared. Really, people are focused on the right tail. I joke the right tail is the new left tail, but that fear of upside has just captivated the options market, and it's really at historic highs when you look at call buying.
And what historically, how does this end well?
So it's interesting. We back tested this. We sort of said post-COVID, when you get into these cycles of exuberance, when you really see call options shifting to these historic levels, what actually happens? What actually happens is momentum begets momentum for quite a bit until there's some sort of clearing event. What's interesting in NVIDIA's case is earnings sort of was the clearing event, and we actually saw more folks go in and buy calls. So the next event we're looking for is March 18th. There'll be an NVIDIA AI conference. That's the next clearing event, and it'll be very interesting to see if that momentum cycles or it dissipates.
So you're looking at something that you're seeing, the phenomenon in the market, and it's all based on one stock.
And I know that makes you laugh, but the concentration of that one stock has become massive. And, the reality is we're not looking just at NVIDIA, but we really are just looking at 3 or 4 stocks that are driving such massive concentration. But what is interesting is post-NVIDIA's earnings, you've started to see, we call this skew inversion, but that outsized demand for call buying in other names like an AMD or a Micron. And those would tell you that essentially what people are looking for is the next pocket of FOMO.
It's called a skew inversion.
That's right, skew inversion.
And that's when call buying outpaces
put buying. So if you think about it, historically, when you're long stock, you want to hedge. And so you would expect put options to be slightly more expensive than call options. When that relationship flips, it makes options people very nervous. We rely on our historical relationships, we rely on our correlations, and they've basically been blown apart since COVID. And it started with GameStop and the meme cycle. You can't rely on these historical relationships the same way you can't really rely on bond equity correlation anymore. They've been blown apart.
Is it that the total number of calls being bought versus puts, or is it the how much the premiums are versus what they're actually worth? So the call premiums are actually more expensive than the put premiums when you have FOMO.
You got it right. We use implied volatility, but it's essentially the cost of one versus the other on an apples-to-apples basis. We sweep that for all 2,000 names in the Russell. We sweep that for all the names in the S&P 500. And that absolute number of inversions, that exuberance, that momentum, whatever you want to call it, has been rising and rising this year.
Well, now we have to decide what to do with it. And do you think that argues for more momentum, or is it too bullish to where you think that it's overdone and ready to peak?
So look, eventually these things go away, but essentially when we back test this and we look 1 week out, 2 weeks out, 3 weeks out, it tends to last. So momentum begets that momentum. It's actually a factor that people have just started trading on their own. So just this idea that the winners continue to win is actually a factor that investors have used in and of itself, agnostic to what the underlier is.
So if you see 14th record for the S&P already this year, you expect a lot more records to come?
Essentially, until some sort of clearing event, that's what we see when we look at history in the post-COVID era. And there are also mechanical aspects, which I haven't gotten into, but when this happens with options, there's dealer hedging on one side, there's gamma dynamics, all these things that actually perpetuate technical momentum on top of just greed.
Well, the NASDAQ finally confirming the highs and the other averages. What's that tell you? Anything that more tells you NVIDIA had good earnings?
Yeah, I think, look, those things continue to perpetuate it. But the other part of this U.S. exceptionalism that I think is interesting, that I've been speaking with investors about, is just China was this story that was supposed to be the rebound. I've been hearing that for the last few years, and I've been on the road a lot the last few weeks. And what I've heard from international investors is there are just not that many other places that go. Their China bets have not worked out. Their EM bets have not worked out. And so that's helped just simple fund positioning into U.S. exceptionalism. And where do people go? They go back into the Mag 7. So this is kind of interesting, but one thing I've heard investors say is if China becomes a story they can hang their hat on again, that might actually be something that breaks the flows away from this U.S. exceptionalism.
That would be so we're already there's indications of some froth from this stuff you're talking about, and that could be what finally results in this trade being, I don't know, less lucrative in the future.
And look, Joe, if you're feeling angsty, the left tail is incredibly inexpensive. It's just that as a derivatives person, you can only say it's cheap to hedge so many times before they kick you off the stage, but it is incredibly inexpensive to hedge, and there are always unknown unknowns in the market.